Here's an introduction to annuities. An annuity is really just a contract owner in an insurance company, and it's with a policy. You're buying a policy from an insurance company. They're designed for long-term investments. They're tax deferred. What would we rather have, taxable or tax deferred? What's better? Tax deferred. They can provide a lifetime income. In Florida, they avoid probate, so they don't have to be in your trust. We're going to talk about wills and trusts. And they could have a surrender charge if you surrender the policy. In an immediate annuity, the payments are locked in using a predetermined formula. So once you turn it on, that's the income. On a deferred annuity, you have other choices, and you can annuitize it or not annuitize it. So without overcomplicating it, it gives you a little more flexibility. An immediate annuity, you're going to give a single premium to the insurance company, and a deferred annuity can either be single or periodic payments over a period of time. And again, the immediate is irrevocable. So you can kind of see the differences between the two. And the immediate annuity is to help pay the income of your daily bills. And again, as I talked about before, you have different payout choices. You can not annuitize it, and you can just pull out, for example, 10% a year, or give me a lump sum each year. Or you can annuitize it, and what that means is I give the money to the insurance company and they give me an income stream. That's what annuitizing means. Fancy word for turning it into a lifetime income. And again, as I discussed before, you could do a single life only, or a life with a certain period of time, or a joint life, or full survivor, or partial survivor. Anybody retired with a pension in here? Anybody retired that has a spouse with a pension? You have the option of taking it on your life only, or if you die, it stops. Or you could take it where it pays a percentage to your spouse when you die, 75% or 50%. And you have to make that decision when you retire. So it's a very important decision on a pension or on an annuity, what type of payout you take. And they will run numerous illustration examples for you before you make that choice. So it's a really important irrevocable decision. Now, fixed annuities. The principal is guaranteed by the insurance company. Right now, a simple fixed annuity is paying about 3.1%. On just a simple, plain fixed annuity, I earn my 3.1 every year, and at the end of a couple years, I pull my money out. Or I take my interest out each year. So those are some of the competitive rates. The interest rate accumulates until I withdraw it. You have different withdrawal choices, and it's money that possibly cannot be outlived if you take it as a lifetime payout. Anybody ever heard of fixed indexed annuities or equity indexed annuities? These have been around for 15 years. They offer a minimum guaranteed interest rate, or they can be tied to an index, like the Standard & Poor's 500 index. So I could put money in a fixed indexed annuity, and half of the money might earn 2 or 3%, and the other half might earn 5 or 6%. If the market goes down, I don't lose anything. That's the way they're designed. So 0 is the worst case scenario with a fixed indexed annuity. You have higher potential interest rate than a fixed annuity. Because on the first example, on a fixed annuity, let's say it's paying 3, this one might pay 0 to 6%. 0 being my worst case scenario. They are long-term investments because you're going to be in it anywhere from 5 to 10 years, but you could pull income out each year. Or if somebody passes away, it becomes fully liquid. So if you've never heard of these, you should really ask your advisor about it, because it's something you should look at to see if it makes sense for a portion of your portfolio. They have different what are called crediting methods and how the money grows. Without confusing everybody, just know there's different crediting methods. Different ways you can earn on the fixed index annuity. Here, variable annuities. It gives you the availability to participate in the market with professional money management. It's a guaranteed interest account, may be available. Not all of them have them. One statement covers all the variable annuity investments, and a death benefit may be available. Variable annuities The negative to variable annuities that I find is there are a lot of hidden fees that you may be unaware of. So one of the things I like to do with prospective clients is to really analyze their variable annuity. And really what we do is call the insurance company and ask a bunch of questions on the speakerphone. And what I have found, the norm is somewhere between 3 and 4% in fees on a variable annuity. So what that means to Terry is she has to make 4% a year just to break even. Well, that's a tough bet. Or the years where the market goes down, the account value can go down. Most people are under the misconception that the account value cannot go down because it was explained to them incorrectly. So I'm kind of a proponent of explaining this stuff. And as a teacher, I think it's important that I educate my students to really question about variable annuities. So one would be, what are the fees? And the fees that are included, one is called M&E, which is mortality and expense fee. One is called an administration fee. Normally there's a death benefit rider fee, a withdrawal rider fee, and an income rider fee. And inside the variable annuity are sub-accounts, which are basically mutual funds. And normally there's a 1% fee to manage the mutual funds. So when you add it all up together, it's usually somewhere between 3 and 5%.